Every time the Fed speaks, market move. Stocks, bonds, crypto all react instantly. But most people don't actually understand what the Fed is trying to do. The Fed isn't random, and almost every decisions come back to one simple framework: the Fed dual mandate. And in this video today, we'll explain more about what the Fed dual mandate is. Hi, I'm Siva, and on this channel, I share more on finance and productivity. And if you enjoy this style of content, please subscribe to my channel. Now, let's dive in. Let's talk more about what the Fed does. The Federal Reserve controls interest rates, and interest rates are the price of money. When rates are low, borrowing is cheap. Business invests more, companies hire more. This allows consumers to start spending more. That usually supports employment. When the rates are high, the opposite happens. Borrowing gets super expensive, spending slows, investment slows, and hiring slows. That cools the economy. More spending and hiring, which is a good thing, can push price higher, which creates inflations. So, interest rates sits at the center of everything: jobs, inflation, and growth, to balance things out. And because interest rates affect both jobs and prices, the Fed has two goals. The first is price stability, and the second is maximum employment. Lower rates help employment, but it risks inflation, and higher rates fight inflation, but it risks job losses. The Fed's job is to decide which risk is bigger at any moment. That's the dual mandate. Now, let's look at the first side of the mandate: inflation. The Federal Reserve aims for inflation to be at around 2% over time. It watches CPI, or Consumer Price Index, and personal consumption expenditure, which is their preferred measure. What matters most is the trend, the core inflation, and whether prices are spreading through wages and services. If inflation is too high, the Fed will tighten the policy, which is to increase interest rates. Now, let's look at the second side of the mandate, which is maximum employment. This doesn't mean zero unemployment. The Fed looks at the unemployment rate, job creations, wage growth, and labor force participation. A labor market that's too tight can fuel inflation, while a labor market that's weakening can signal recession. Now, let's bring it to life. On this chart, you will see the blue line, which is the Fed fund rates, and the green line, which represents inflations. As shared earlier, the Federal Reserve inflation target is to be around 2% over time. However, if we look at the current rate of inflation, it is still hovering around 2.6%. The question is, then why did the Fed start cutting rates in mid-2024? The answer is because of the dual mandate. When you add the red line, which is the unemployment rate, you will see it started rising around the same time. So, even though inflation wasn't fully back to the target of 2%, the balance shifted. Protecting the job market mattered more than squeezing out the last bit of inflations. Now, why does this matter for markets? Markets move based on which side of the dual mandate dominates. Inflation problem, expect higher rates. Weak job and falling inflations, expect a rate cuts. Understanding this framework helps you anticipate the policy and not react to headlines. The Fed dual mandate is simple: stable price and strong employment. Interest rates are just the tool to balance the goal. If you enjoyed this series, please give this video a like and subscribe to my channel, and I'll see you in the next one.